Good evening and welcome to the second session in our Money Makeover series. My name's Daniel Grote, I'm the Telegraph's investment editor, and tonight our focus will be on ISAs. Now the clock is ticking towards the end of the tax year on Monday, but once you've used up as much of this year's ISA allowance as you can before the deadline, the next thing to sort out will be how to invest the money. And that's what this session is all about. With the British economy set to reopen while other areas of the world experience a third coronavirus wave, a Brexit deal now done, huge American government stimulus and fears of rising inflation, there's no shortage of issues for investors to consider, which is why I'm delighted to be able to welcome tonight's two guests. First, I'd like to introduce James Bartholomew. Many of you will know James as the Telegraph's Diary of a Private Investor columnist. A journalist and author, James is also a seasoned investor running his own portfolio. So it'll be great to get some of his insights on the DIY investor experience as we all look to give our portfolios one last spring clean before the end of the tax year. Thank you for joining us, James.
Hi.
Hi. And also joining us is Susannah Streeter. For 17 years, a business news presenter on the BBC before joining Hargreaves Lansdown, the broker, last year. At Hargreaves, she's focused on the outlook for stock markets and economies around the world. So her views should be of great help as investors prepare their portfolios against an ever uncertain backdrop. Susannah, thanks for joining us.
Hello, great to be here.
For our first topic, I've picked two pre-submitted questions, which are nice and broad, and I'm hoping will give a good introduction to your investment outlooks, James and Susannah. So we've had two questions. One is simply, which sector is the best to invest in? Another, which geographic regions would you recommend for the best growth from share-based trusts or funds for 2021 in an ISA? So Susannah, if I could come to you first, maybe with that first question, just on the sectors to invest in, what are the kind of areas of the market that you're seeing the best opportunities in?
Well, I think the first thing to say is, don't put all your eggs in one basket. That is the first thing, not any one sector. To be diversified, you need a combination of eggs and baskets as well. And that means different sectors in terms of industries and also different geographies as well. Now, companies listed in London are thought to be undervalued, partly due to Brexit, but also partly to do with how the index, the FTSE 100, is weighted because there is a greater weighting towards, for example, mining, energy giants and financials, for example, whereas in the US, of course, really heavy tech, where that sector has done very well during 2020, but we're seeing that come off a little because the tech sector is considered to be a bit frothy with the fact that inflation could be down the road, that could erode the value of future earnings. So I think certainly commodities, where they haven't been in favour, there has been this rebound in economic activity around the world as the world recovers from the coronavirus crisis. So mining certainly would be a sector I would say to consider. Longer term, healthcare. We've seen just how important healthcare has been over this past year. We have aging populations in many wealthy countries around the world, and that need is only going to get greater. So I think that as well, infrastructure would be one to watch. Seen as a bit more defensive, but also with the huge stimulus programs around the world, not least in the United States, I think infrastructure would be a good watch as well. But very quickly, before I go on any longer, I just think in terms of geographies, it's quite useful perhaps for you watching to get a gauge of what people have been putting their ISAs into over since the beginning of the year in terms of Hargreaves Lansdown, and it's been global funds, also an emphasis on China and Asia Pacific area, the US as well, and actually UK smaller companies.
Mm-hmm. Great, thank you. And James, if I could bring you in, and just looking at the way that you run your money, do sectors and geographies, do they factor in your investment process? Are you trying to get a balance between different sectors and geographies, or is that not the way that you think about it?
No, I don't really do balance. I do very unbalanced, but I should say right at the outset that I don't take anything I do as a recommendation, because I do quite a risky, what other people would regard as a risky kind of approach. I certainly don't go for sectors as a whole. I tend to go for individual shares, which I think have special opportunities, special chances of going up a lot. So I take risks, and at the moment I have probably, I think I have, about 8% of my portfolio in one single stock, and another 8% in another one, which is actually preference shares of the same company. So don't do as I do, unless you're really confident and experienced. But in terms of sectors, I mean, will emerge. I am very concerned about the situation at the moment. I think the investment position at the moment is about as dangerous as it has been for a very long time. But if I had to pick a sector for the, as it were, least bad sector, I think I would agree with Susannah that commodities, or certain particular commodities, and I'm thinking of palm oil actually, have a way to go. I think that also, I think UK commercial property, which has been so badly hit, that some of those companies are pretty undervalued. So those are two sectors I would look at. In terms of geography, well, I've always been a fan of the Far East. You know, they have pretty low taxes, and they have pretty good laws that are enforced in large parts of it. You know, Singapore has done incredibly well. Korea has done incredibly well. So you can catch a ride on South America, and good luck to you if you get the right timing. But that's a much more, you've got to be watching that very closely to get it right. I think long term, I'd go the Far East.
Yeah, I just wanted to come in there as well. It might be worth heeding the International Monetary Fund's warning this week about how the hangover from COVID is going to hit developing and emerging markets harder for longer, and that the scarring is likely to be more profound in developing and emerging economies. So if you're looking at geographies that might recover quickly from the pandemic, I think that kind of warning would be wise to heed. And obviously, as we've seen with the slow rollout of vaccines in Europe, and some other parts of the world, I think that will mean that those sectors are going to be bouncing back a lot slower from the pandemic. But I do think that emerging markets warning is quite an interesting one, which came out this week.
And James, if I could come to you with our next question. I mean, you sort of hinted in your last answer at some of the fears that you have that are reflected in your investment outlook. And we've had a question come in, a pre-submitted question, asking, how do I minimize the impact of inflation on my ISA? Do I invest more in non-UK products? And this really sort of touches on what you were writing about in your last column for us, about your fears for an upsurge in inflation, and really what investors can do to hedge against that. And if you look at the areas that investors have tended to move towards when they do fear inflation, gold's been a traditional hedge against that, but it certainly hasn't done that job this year, where inflation fears have been rising, but the gold price has been falling. But I think the point in your column that readers will latch onto is what you were saying about shares, that you think they're just about all right for the time being, but that you're ready to sell them quite quickly if inflation did take off. I wonder if you can sort of talk a bit about that, about sort of why a rise in inflation would present a danger, and what investors can do about that.
Well, I mean, for me, the particular moment is extremely perilous for investors, and more so than Brexit, more so than elections, really, really dangerous. And the reason for that is, and first of all, I should say that this is not consensus view. You can ask Christine Lagarde, she will say it's rubbish. You can ask people at the Treasury, they say it's rubbish. President Biden, they won't agree with me. I'm in a minority here. So this is not just conventional wisdom you're getting. This is my personal view. What has happened is that the money supply, in response to COVID, the money supply of many countries has risen very, very dramatically. More dramatically, I think, probably since, well, the last surge of this sort took place in the dreaded 1970s. and that with horrible results. So in America, the broad money has risen by 22.6% over the last 12 months. In Britain, it's risen by 15%. Now, these are really big numbers. Normally, it would be 6 or so. So we're talking about excess money growth above normal of 10% plus. Now, monetary theory is that in the long run, extra money will mean extra inflation. You can't just make the country richer. You've got to, the more money you create, the less that money will be worth. In other words, you have inflation. Now so we could get much higher inflation, I believe, than anybody's expecting in the mainstream. The Economist is predicting 1.9% for the current year in Britain. And I think that's going to be a way underestimate. Now, the consequence of this is that the central banks, belatedly will say, oh my God, we've got to stop this inflation. We didn't expect it, but now it's here. We've got to try and stop it. So they will raise interest rates. They will stop quantitative easing. Money will get a lot tighter. And when they raise interest rates, that will hit shares in double whammy, because on the one hand, the dividend yield of shares will be less attractive. And secondly, those countries that are borrowed on overdrafts will find their interest cost goes up. So suddenly the appearance of most shares will deteriorate dramatically. And I've been thinking, how do I get through this? Because I lived through the 70s, I'm that old. And I know how difficult it was. I had a house through most of that time, and you might think a house rises with inflation. Well, it did eventually, but that was actually sort of 8, 9, 10 years later. Initially, it was just flatlining while inflation went up as much as 27% in 1 year. So the real value of houses was going down. And there was really no hiding place. Even gold, the reason why gold is not going up, despite fears of inflation, is because it is feared of the high interest rates, because the carrying cost of gold rises the higher the interest rate. So I have difficulty in finding a hiding place from what I think is going to be a very difficult few years.
And Susannah, if I can just bring you in on this on inflation, because I guess we've had a sneak preview, haven't we, this year, as to what will happen to markets if there is this upsurge in inflation. We've had this rise in fears about a surge in the pace of price rises. We've seen growth stocks sell off quite sharply, and we've seen commodities and more value type shares rally. Can you just sort of explain sort of what's going on there, and why inflation is such a bad thing for bonds and for growth companies, for technology companies?
Yeah, so for example, the expectation for higher inflation, as and we were just talking about, is that actually there will be then an increase in interest rates further down the line, and higher rates would erode the value of future earnings. That's had a real pressure on the tech stocks in particular. I do have to say that you mentioned about Christine Lagarde, and in fact the consensus is, of course, that actually inflation, we are going to see a spike this year, but that it won't be sustained. And it really does seem as though the European Central Bank, the Federal Reserve, the Bank of England, they're all singing from this same hymn sheet, that they believe actually that there will be a spike, but actually it will go down. We have seen, for example, a sustained rise in the oil price, and it's come off a little bit recently. And I do think that, that needs to feed through. And as a result of all this, though, the expectation that we are going to see a rebound in global growth is this rebound in economic activity. And that has led to this spike in bond yields, with this expectation of inflation down the road, and also this expectation that the banks will take the pedal off these quantitative easing programs that we've seen, this mass bond buying, and that is all feeding through and having this effect. It does seem clear that nobody really knows what's going to happen. After QE1, so after the financial crisis, there was expectations of what would happen once QE started to be wound back, but actually it didn't quite happen as was first expected. So I don't think anybody really knows, we're in such uncertain times, exactly what is going to happen. Some people do believe that there is going to be this sustained rise in inflation. Others don't think actually that the global economy is robust enough for that to happen. So I do think that it just feeds into this really strategy that you must make sure you are very well diversified across various different sectors, and perhaps, you know, take some kind of more defensive strategies, use funds which perhaps do have some, you know, inflation-linked bonds, for example, in the mix, some commodities, but as we were saying, the gold doesn't necessarily behave as an inflation hedge all the time, but it is really useful to try and kind of shelter assets in such a scenario.
Mm-hmm. And James, if I can just bring you back on this, so what are you doing with your portfolio, and what will you do about this sort of inflationary threat? I mean, you mentioned in your article that you've been able to sort of bet against or short government bonds through the use of exchange traded funds, but that sort of hadn't really yielded the results that you were looking for. Are there any other ways that you're looking to kind of protect your portfolio against inflation?
Can I just say before I do that I think a lot of people, as Susannah indicated, are drawing comfort from what happened after 2008 crisis and the quantitative easing that took place and how that did not result in inflation. But I think that is a mistake to draw comfort from that for this reason. The monetary economists, such as Professor Tim Condon, were not worried about that causing inflation for the very simple reason that money supply overall did not rise. Money supply would have fallen but for the quantitative easing. Money supply stayed stable. Now the situation now is completely different because the money supply now is rising very, very fast. Anyway, to go back to the question you asked, I suppose that you mentioned shorting bonds, and that is probably the one way where, if I'm right, you may actually make some money as opposed to losing it. I have shorted US. It has to be long bonds. There's no good shorting very short-term ones because that's where the change in capital value will take place. So I've shorted US Treasury bonds, the very long-term ones, and you can do it either simply or double or treble the effect of on one particular. So you can have a sort of 3 times effect on one bond. However, that obviously is much more risky. So I've done a mixture of just straight shorting and then triple shorting, and I've also shorted the longest UK government bond that I can, which is a 10-year bond. I haven't found a way to short longer bonds than that, which I would prefer. Those shorts have made profits so far, and I hope they'll make. I've been disappointed by how small those profits have been, which is for mysterious reasons. But they have gone up, and I'm certainly been buying more of them in the last week, in fact.
It can be a dangerous business, as we've discovered over recent weeks, dabbling around, shorting, for example, trying to judge the stock market. And we certainly have seen hedge funds caught with their trousers down, haven't we, over the whole GameStop saga. And certainly that is a risky strategy to undertake. I mean, if you wanted to look at particular funds, for example, there are a number of different funds that you could look at. For example, there's the M&G UK Inflation-Linked Corporate Bond Fund, which aims to deliver a return greater than UK inflation over the longer term. And also you could potentially look at Troy Trojan. It might not be a perfect hedge, but it does invest in global equities and also gold-related investments. So, I mean, again, it's very difficult when you're trying to, look at what you could do as a defence. But if you are particularly worried about inflation, I probably wouldn't start shorting.
Well, can I just say yes, I totally agree that shorting. I mean, basically, I think we're surrounded by risk at the moment. I don't think there's a safe place. I don't think cash is a safe place because of the inflation. But I mean, I agree that obviously shorting bonds and triple shorting bonds is you've got to only do it with money you can afford to lose. Do not go crazy with it. And I'm not suggesting it for everybody. Somebody I noticed on the chat has said, talk is meant to be about ISAs. Why are you talking about shorting bonds? Well, you can short your bonds through ISAs by buying an ETF. At least some people can. I don't know. I may be regarded as a semi-professional investor, so I may be allowed to do it in a way that others aren't. So you'd have to talk to your own ISA provider. But I currently I'm able to buy ETFs shorting bonds in my ISA, and I'm doing so.
Certainly, the message that you don't like bonds, that's coming through loud and clear. So that's kind of, let's look at bonds, because we've had a couple of questions on that. A pre-submitted question asking, as markets continue to climb to new highs, how do you de-risk your portfolio? Are corporate bonds the answer? And another, a 60-40 portfolio, so 60% in shares and 40% in bonds, used to be the norm. Where do we go now to replace the bonds? Susannah, what's your kind of outlook on bonds and their place in investors' portfolios?
Well, I do think, as we've already pointed out, that there is this risk as well. We've certainly seen the sell-off in the bond market, and with that expectation likely to continue when there starts to be this unraveling of QE and tightening of the money supply. Certainly corporate bonds look like they could potentially offer maybe slightly more defensive haven compared to government bonds. And then really, I would say, look at more kind of defensive equities. Infrastructure, we've something like, for example, to take a share price like National Grid, for example, that could be, could be a safer bet, because it's kind of promising a certain, amount of return in terms of the dividend. And so in a way, it could offer some kind of shelter against inflation. It's promised to grow its per share dividend in line with the UK retail price index for the foreseeable future. So, there could be some growth opportunities, because the profit that the group is allowed to make, obviously, it does face quite significant regulation. It's based on the money that it invests in the grid. And also, some of the infrastructure will need updating soon for electric cars, so there could be further investment. So, it could be a bit of a standout in the utility space. So that might be one to watch.
And bonds are, they're seen as useful parts of a portfolio, especially where they're combined with shares, because they help to soften out some of the volatility that investors may experience in the stock market. James, is there anything in your portfolio that does a similar type of job to bonds? Do you have kind of a safer bit?
No, I certainly don't have a safe bit in my portfolio. But I do think that, personally, I think long bonds, there's a difference between short bonds and long bonds. Ones that are going to be repaid in 2 years' time, I think that's fine. That may be a good place to be. But what I would avoid is long-term bonds where you're committed to a very low interest rate for a very long time, because that will become redundant, I believe, in a year or two's time. And you will be able to get much better interest rates in years' time than you can now. So I wouldn't be in a long-term commitment to a bond of any kind. In fact, I have got some preference shares, which are very light bonds, but they are so cheap and so demolished that I'm hoping that they will survive. But basically, I would avoid any long bonds of any description anywhere in the world at this moment.
And actually, just to pick up on Susannah's point, where you were mentioning alternatives to bonds and more kind of defensive investments. So we've had a couple of questions: which investment sectors are likely to give stable growth over the next 12 months? And I'd like some general pointers to lower risk ISA investments going forward. And Susannah's covered some of those. I'd just like to flag as well that last month we revamped the Telegraph 25, which is the list of our favourite funds. But alongside that, we also have some other lists, smaller lists of 10 funds targeted at investors with particular focuses. So we have one for growth investors, for more adventurous investors, one for income-focused investors, but there's also one for defensive investors, and there's 10 funds listed on there that we think are good picks for investors who whose focus is not only growing their wealth but also preserving it. And the link to that article will be appearing in the chat box. So moving on to another topic, another one where we've had a number of questions is on income investments and growth investments. So quite a few questions on this. One that I'll pick out, so one viewer asking, I've retired age 65 and my wife age 63, and we have £20,000 each to invest in this year's ISA, one for growth and one for income. What should we be looking at, please? So Susannah, if I could come to you, maybe not so much looking at the specifics of that particular viewer's circumstances, but more at which sort of investments are good for those investors who are focused on getting a regular payout, for income-focused investors, and which others are better for those whose main concern is growing their capital.
Well, say, for example, you take two investment trusts. I mean, you could go for, say, the City of London Investment Trust. You could look at that one. So it's known as one of the Association of Investment Companies Dividend Heroes. So it's managed to its dividend grow its dividend for more than 50 years. And it focuses on UK equity income, looking for UK companies with the ability to grow earnings and pay dividends to their investors. Or a higher risk trust could be the F&C Investment Trust, which is a global equity investment trust. It half kind of invests in US companies, the other half more markets like UK and Japan, some emerging markets and smaller companies. And it does have still a kind of tech angle to it. Now, tech is really interesting at the moment because, as I said earlier, has been seen as a bit frothy, particularly, companies like Tesla, which still has a lot of fans out there, but it has to sell a huge amount of cars and batteries in the future to get anywhere near its valuation. And of course, there are lots of different companies trying to eat into the electric car market space. But other companies, for example, like Facebook, even though it's got the spectre of regulation hanging over it, it's very much kind of got this kind of network buildability because it's gained so many more users over the pandemic, 3.3 billion, and users mean advertisers, and so it can keep growing. So even though it looks like tech, in many ways, the whole sector could look overvalued, those companies that can benefit from that kind of network effect do still look potentially good prospects going forward over the longer term. Obviously, Facebook could get broken up into three smaller companies, WhatsApp, Instagram, and Facebook, but then there would still be three well-performing smaller companies. The likes of Amazon, for example, it's had this huge shift. We've seen this huge shift to online shopping during the pandemic, and it has been able to capitalize on that as the king of e-commerce. Might have quite a high price to earnings ratio, but it does still have this network effect. It just keeps growing because of the platform that it sits on. And I think it'd be interesting to look at other companies that are kind of trying to emulate that space. So, for example, we had results out today from Next. And certainly Next is trying to move into being more of an e-commerce platform and being a platform for other retailers to sell on as well, and trying to replicate that network effect. So it doesn't necessarily mean that the tech sector shouldn't be invested in. You've just got to try and pick those companies wisely. And
James, if I could bring you in, and I suspect I know the answer to this question,
but I'll tell
investing
you.
For
the question was, income. What's an investment for income and a investment for growth? Mm-hmm. Okay, I would say don't bother about growth. You're not going to get chances of getting good growth are quite remote, and making good luck to you. I'd be marvelous if you can. I think with income you've got a better chance. And there are quite a few high income shares around. And what I haven't mentioned before is that one sector will actually benefit from the scenario that I've mentioned, not forever, but initially it will benefit. And that's the banks. because the banks, if we have higher interest rates, they're on their huge balances, they will make more money. So initially, the banks will do quite well, and a lot of them have really, their share prices have been smashed, and so they offer pretty good value, and they not last year, but in the coming few years, they will offer quite big yields. However, I can't say this is a perfect place to go, because after a while, if I'm right, and the inflation really picks up and the interest rates pick up, then the companies that they lend to, some of them will go bust and they'll have bad debts. So it's not an evergreen, this is fine for all time. But I think for a while, the banks might do quite well over the next 12 months. But they might get, if there's a big market retreat, they might get hit. Over and over again, people who have not done investment for a long time want to have growth without much risk. They want a kind of best of both worlds. They want the cake and eat it. And I'm afraid investment doesn't work like that on the whole. On the whole, in the long term, you might be able to get that, but short term, there are some real lumps and bumps. And if you want to make money, you've got to risk money. And sometimes you've got to take your cash off the table and say, this is not a good time. I'll stay in cash. I think cash is one of the places to be at the moment. I know it's an ISA, but you can have some money in cash. And you may find by holding cash for the next 12 months, you can then get a much more attractive investment in 12 months' time. Even though there's going to be inflation in the meantime, you'll lose a bit of money, but better to lose a bit of money than to lose a lot of money.
On the other hand, you could say that perhaps now would be the time to, say, for example, invest in an index tracker, because on a historic basis, the total return is around 7 to 8% on a historic basis. That's not obviously a guarantee of future earnings, rather than seeing your cash pile erode in a cash ISA. I think really what we're talking about when we're discussing this is it's really good to think by diversifying, have a bit in cash, have a bit in what you could consider might be potential for growth. So certain tech stocks, for example, and then have some more defensive areas where you could think, well, actually, that's a much kind of more stable income. So you also could look at it as having a core of investments, like a planet with like satellites around it. So one core where you could be less risky, and then more risky investments around the edges, and that would be quite a good way of looking at it.
And that core and satellite approach, I guess that's bringing us more towards kind of questions around how you construct and how you organize a portfolio, be it in an ISA or elsewhere. And we've had some questions on that. So how many different funds or stocks should I be looking to hold in my ISA? James, is that ever a consideration for how you run your portfolio? Is there a certain number that you're aiming for? Is there too much?
Yes. Yeah, a long time ago, I read an article which seemed to be authoritative that said you should have only 7 shares in your portfolio, because then you would watch them very, very carefully, and you will, you'd take right decisions about them. I used to have just 7. In fact, I used to have just 2, but now they just multiplied like sort of babies or rats. They're multiplying away under the floorboards. I got far too many now. I'm not. I ought to be more focused, and I can kick myself and say I ought to sell some, and then I don't quite get round to doing it. So yes, you ought to be diversified. But can I just pick up on one thing that has been mentioned on the chat?
On the chat, yeah.
One person said wine. Now, I thought that's actually quite an interesting idea. You can't hold wine in an ISA, I don't think. Maybe Susannah can correct me, but I think as I think inflation is going to rise, I would think anything you're going to buy over the next 2 years, like a car or antiques or wine, something you actually want, buy it now, because it's probably going to be more expensive in 2 years' time. And that way you get a tax-free gain. Fill your wine cellar. If you like wine, fill it up, and you will not regret it in 2 years' time. That's to say you're still sober.
Well, there you go. There's one solid tip. Just to add on the point around how many funds that you should hold in your ISA. There is actually a Telegraph article specifically on this question, and the link to that should appear in the chat bar. But just to give my view on it, I would say that really the main aim of holding a number of funds is to provide diversification. You know, that's a word that's come up quite often in this session. In other words, really, that all your eggs aren't in the same basket. So really, how many funds that you hold is a function of that. So you could just buy one if you wanted to keep things really simple, provided that fund gave you enough diversification across different sorts of assets in different areas of the world. So multi-asset funds, which hold a number of assets, so shares, bonds, property, commodities, they do this sort of job. Or if you wanted to keep things really simple, you could look at something like one of the Vanguard Life Strategy funds. So these are funds that hold bonds and shares in varying proportions, depending on how much risk you want to take, with the funds targeted at risky investors holding more shares. And the question of sort of how many funds you should be holding, that certainly does come into play where you're holding funds that are doing something more specific than that. So if you're holding a fund that invests only in British stocks, and then you're holding another fund that invests only in American stocks, in that case, you do want to be holding multiple funds, because you want to be covering as many areas of the market as you can. But I mean, just sort of to echo sort of James's point around sort of multiplying portfolios, I think if you've got more than 15, and certainly if you've got more than 20 funds, then it does become quite hard, unless you have a lot of time to monitor investments, just to keep tabs on what everything is doing. So on to another kind of question around portfolio construction. Is there much benefit from investing in individual stocks rather than investment trusts? Investment trusts appear to perform reliably well and carry much less risk than in individual companies. So we've already had from Susannah, we've had mention of a couple of investment trusts that are deemed sort of dividend heroes, like City of London. James, if I can kind of bring you in, so you're much more of a shares than a fund investor. What sort of drawn you to that, and why do you prefer that sort of investing?
I mean, I think one has to bear in mind that you've got different kinds of investors here. I mean, some people here will know nothing about analyzing a company, and they shouldn't invest in individual companies because they don't know what they're looking for, and that makes sense. They should go into funds. But if I started off in banking and did credit analysis and really got into corporate analysis and share valuation, and so I predominantly invest in shares. The only times when I don't, I'm looking for special situations where I think I'm going to hope to make a really big return. That's what I'm doing. But the only times I hold funds really are either exchange traded funds, like for shorting bonds or for doing some other specific task, or country funds where I really haven't got the time and ability to research individual companies. So at the moment I hold a country fund in Korea, one in Germany, and one in Poland. And so that's a way, if I want to get exposure to a country and I haven't got ability really to find individual companies, then I go for a fund.
I mean, I just come in on the point about sort of funds versus shares. That this point around diversification that I was mentioning earlier, that is a lot easier to do with funds. When you're buying a fund, they will be investing across the whole of the asset that they're sort of focused on. So, they will be investing across, if it's a British stocks fund, they'll be investing across the British stock market. And so they'll provide broad exposure. Whereas if you're holding a portfolio of stocks, really that's it's a collection of bets on the performance of those particular companies and the particular industries that they operate in, which is fine if that's what you want to do, but it's harder to get the sort of safety provided by diversification. And just on the point around investment trusts, as opposed to other sorts of funds, they have historically provided better performance. And actually, there's a number of cases where you have a manager that's running an investment trust and is also running a fund, and they're broadly the same sorts of portfolio, and usually it's the investment trust that does better. And one of the main reasons for that is that investment trusts are able to what's called gearing. They're able to borrow, so they can borrow money and use that to invest, which then amplifies returns when markets are rising. But obviously, when markets are falling, losses will be steeper. But over the long term, and when we've had this long kind of bull market with periodic crashes obviously along the way, that's led to greater long-term returns. So just on to another question that we've had around ethical and green investments. How to identify the right ISA? Will green or ethical ISAs be a wise choice as well as an ethical one in uncertain times? Susannah, if I could just kind of ask you on that, because environmental or green investing, often called sort of ESG investing, environmental, social and governance issues that feed into the investment process. I mean, that's been a big area of growth, a lot of funds launching in that area and a lot of people putting money into them. What do you see as the outlook for those sorts of investment approaches?
I think they're becoming more and more popular, and they will continue to do so, because I think so many more people, individuals like us, but also institutional investors really have much bigger eye on ESG criteria now. You can just take what happened with Deliveroo this week. We had a number of different institutional investors saying they weren't happy with the working conditions under the contractor model. So it just shows, how it can have an effect on, IPOs, the launches. And increasingly, we are seeing many more retail investors really interested in ESG investing. And obviously, if a company has an eye on how its workforce is being treated, what impact it has on the planet, then over the longer term, you would hope that that company has better growth prospects, because the whole world is now turning to that. And that is where also there is a lot of expectation that there will be growth going forward, because we've got this net zero by 2050 target, and there is over the next couple of decades going to be a huge amount of investment put into that. But of course, when you talk about ESG, there's lots of different criteria. You may be really anti-animal testing, for example. You might not want to invest in pharmaceutical companies that carry out that. You may just want to be investing in companies that you believe offer really good stewardship for the planet. So there are different criteria, and actually it's quite difficult to define what is an ethical fund, because it depends on what standpoint you come from.
And we're fast sort of running out of time, but just quickly, I've seen one question sort of pop up in the chat box. Are we not going to mention, this is from James Simmons, are we not going to mention the world's best performing asset class, cryptocurrency, has risk, but as discussed, stocks and cash do too, mainstream adoption increasing along with the price. Now, you can't actually hold physical Bitcoin in your ISA, but there are shares and funds that you can buy that provide exposure to the behavior of cryptocurrencies like Bitcoin. James, what's your take on this cryptocurrency? Is it an area that you've looked at?
I've read various articles about it, but to be honest, I just don't understand it. I don't get it. I don't get how it works. I don't get who controls it. I don't know what the long-term outcome. I don't know if there's any fundamental value there, and so I don't touch it. I'm maybe missing out a lot. Maybe it's because I'm old and fogish that I'm just missing it all out. But I'm missing it and continuing to miss it until someone can explain it to me.
And Susannah, I mean, I've seen kind of Argo blockchain, which kind of operates in this area. That's been one of the sort of most traded shares on Hargreaves Lansdown this year. It's certainly something that's kind of about animating your customers. Yeah,
I mean, absolutely. You look at Argo blockchain, it really has followed Bitcoin's rise and fall. And the problem is that lots of investors are getting into cryptocurrencies and then the associated shares through speculative bets, really, rather than any intrinsic value currently in cryptocurrencies. Very difficult as a means of exchange. And so certainly, as we were talking about a planet and satellites around it, or a main investment plate with lots of sides around it, if you've got money to lose and you want to dabble within cryptocurrencies, obviously it's up to you. but the price rises that we've seen have been on the basis of speculation that it's going to go higher. And of course, it can drop. I mean, it's dropped Bitcoin, for example, 20% in one day. So you never know when you're going to be in that drop. So it does remain a highly speculative investment. I mean, you have things like NFTs, non-fungible tokens now that bands like Kings of Leon are using to sell their records. And in many ways, some people would say, well, that's using the Ethereum blockchain. Many people would say, actually, that's more potential, say, for example, for the music industry. But again, if there's an intrinsic benefit in that NFT, and actually you believe in the Kings of Leon album and you want to own it, well, that's great. But if you are just purely buying it for speculation, that goes up as well as goes down, and can just as well go down as going up. You get my drift? So I think it's highly dangerous just to be buying them with an expectation that they will keep going up.
And one for the very sort of far removed kind of satellite, and not anywhere near the core, right? Excellent. Well, we got that message. So I think that does bring us to the end of our session. So I'd really like to thank James and Susannah for all the really useful information and answers you've given. And I'd like to thank you to everyone who's joined us this evening. Thanks again for joining, and I hope you have a great Easter weekend. Goodbye.